Britain's economy hit a wall in July, leaving politicians and businesses on edge. After a surprisingly strong first half of the year, the UK managed zero growth in July, just as many analysts predicted, but still a blow for a government gearing up for its November budget. And this is the part most people miss. Beneath the flat headline GDP number lies a tale of two sectors pulling in opposite directions. But here's where it gets controversial. Manufacturing output plunged by 1.3% in a single month, its steepest decline in 12 months. This segment, which accounts for about 9% of the entire economy, saw big losses in computers, electronics, and pharmaceuticals. Meanwhile, the much larger services sector inched ahead by 0.1%, narrowly beating economists' forecasts. In plain terms, while shops, restaurants, and banks are barely growing, Britain's factories are slipping backwards, sparking questions over whether years of underinvestment have finally caught up with us. And this is the part most people miss. On a 3-month basis, the Office for National Statistics' preferred measure, GDP growth cooled to 0.2% in the period to July, down from 0.3% in the previous quarter. In annual terms, output rose 1.4% compared with a year ago, matching June's figure but falling short of the 1.5% some forecasters had hoped for. Why the slowdown? Several headwinds are at play. US tariffs remain a drag on global trade, keeping British exporters on their toes. Inflation is still running at roughly twice the Bank of England's 2% target, eroding consumer spending power. And uncertainty over looming tax hikes has many firms postponing hiring and investment decisions until they know the full picture. The goods trade deficit also widened to £22.244 billion in July, the widest since January 2022. While exports to the United States have yet to bounce back to pre-tariff levels, July's jump in imports from the European Union contributed most to the gap. In simple terms, we're sending more money abroad for goods than we're bringing in. Incentives, reforms, and the budget. Finance Minister Rachel Reeves insists the economy isn't broken, but it does feel stuck. And she's unveiling plans to simplify tax rules and cut red tape on construction permits ahead of her November 26 budget. The idea is to spark business expansion and convince independent watchdogs like the Office for Budget Responsibility to downgrade their borrowing forecasts. Yet critics are already circling. Conservatives warn that soaring long-term borrowing costs, even hitting their highest since 1998, make painful tax rises almost unavoidable. Some business leaders say they're holding fire on growth plans until new employment laws and potential levies are clarified. Is it fair to blame years of underinvestment as the Treasury does? Or are regulatory burdens and inflation the real culprits? And this is the part most people miss. The Bank of England expects just 0.2% growth in the third quarter, reinforcing bets that we'll only see around a 40% chance of another rate cut this year. Thought-provoking questions for you. Which factor do you think is doing more damage? Stubborn inflation, underinvestment, or looming tax hikes? Do Reeves's pro-growth tweaks stand a chance of reviving expansion, or are they too little, too late? Share your views below, and let's debate whether policymakers are reading the UK economy right or completely missing the mark.